Michael and Ryan have prepared for an interesting presentation that we're looking forward to. Just know that they're one of our partners, and our job at Fulcrum Financial Group is to help you to get you to your goals. It's certainly an uncertain time. Giving innovative, honest, caring advice is what we do for you, and it's so nice. So thank you, Michael and Ryan, for partnering with us and helping us with today's presentation. So Michael, will you kick us off?
No, of course. Thank you, Sarah. I want to thank you, Katie, Alan, and the Fulcrum Financial team. Appreciate the time here and appreciate the time to everybody on the call. I think the best way to start this conversation is going to be to talk through really what happened over the last 2 years. Looking back to January 2020, we were in a strong place. We were coming off a year where the S&P was up 31%. Inflation was in check. Although we had the pandemic really kind of spread across the globe, it shook things up quite a bit come March 2020. It really forced, the entire world to go into lockdowns, and that practically changed overnight. So this caused the deepest recession that we've seen since the Great Depression, a little more than a decade ago. And then as a response, we saw vaccines, they rolled out at remarkable levels. You had extremely high fiscal stimulus injected into the economy. And then as those lockdowns did ease up a bit throughout 2021, you had an extremely, I would say, robust rebound from consumer demand. Although there was some collateral damage there, and that's going to be your global supply chains. They were severely disrupted. They were slow to respond to that massive shift in demand patterns that we did have. And that is really one of the main drivers that's contributing to the inflation levels that we're seeing today. These are levels we haven't seen since the 70s. There's no question about it. It's concerning, it's painful. But overall, like our central scenario, our base case scenario here, it's not going to include a decade long of extremely high and rising prices. It doesn't mean that we won't see elevated prices over the next year or two, especially considering what's going on with the humanitarian crisis in Ukraine. That did escalate rather quickly over the last few weeks. So that is something to kind of keep in the back of our mind, that it could, I would say, have some effect on inflation, something that we didn't see coming into 2022 at least. I'm sure there's a lot of questions that you all have really around inflation, what it means for your portfolio. And that's something that we do plan to address today. We'll walk through really why is inflation rising, what it means for your portfolios, and really how have asset classes and portfolios perform during inflationary times. So really getting started into this presentation here, after I set the stage with I would say a brief recap. This graph shows some of the, I would say, largest and smallest price changes that we've seen over the course of 2021. The key point, it's going to be the goods that we've been using the most. They're going to be the ones that are seeing the largest price increases. It's something that we're all feeling. If you focus your attention here on the leftmost bar, that's going to be your gas. It was up 50% from a year ago. Demand for gas virtually had the rug pulled out in the heart of lockdowns. That sharply reversed course as the economy started to reopen. While these levels did come down a bit in the most recent data that we have and that we're seeing, the current situation going on in Russia and Ukraine, that is adding some continued upward pressure. So we could see some elevation here going forward. But there are, I would say, certain levers and certain, I would say, areas that not only US, but globally can use to help, I would say, sustain some of that. That's going to be oil deals in other countries, OPEC production increases, the release of strategic supplies that we have in the US, in Europe. They're all levers that could be pulled to help curtail some of that. If we move and work our way to the right of this graph, you're going to see used cars. It's up 37%. You're going to have bacon and eggs up 19 and 11%. Those are huge increases. And these are just, I would say, really a few examples of, I would say, price increases that could help explain the change in consumption patterns. I mean, one example of that, I guess, comes to mind, and you can kind of relate to this slide here, is the changes to your daily life. Instead of going to the office, you're taking the train, the bus, mass transit. You're going out to lunch every day. That's something that just kind of stopped in its tracks. That shifted to really working from home, making that bacon and eggs in your kitchen. And then if you had to go to the store, you're taking your car. And if you didn't have a car, you're likely going to go out and get a car or purchase a car. And that's some of the things that are increasing some of these price levels. I mean, on top of that, which isn't really pictured here, is you have home improvements. They were super popular. You have durable goods as a whole. They saw major increases in purchases. That's going to be your washers, your dryers, your used cars. These are the things that saw huge changes in prices. And if you really think about, I would say, how you shifted your spending patterns, it went from going to restaurants to massive purchases. These massive purchases are going to, I would say, take longer to get here. They're not easy to ship, hard to maintain the inventory levels there. And that's where you're seeing that disconnect in supply chains. And that's what's ultimately driving the inflation in general to increase. But I mean, on the contrary, working your way to the right of this graph, you see things like cosmetics. You're not seeing large increases like you saw with used cars and some of these durable goods. People weren't going out. People weren't using cosmetics. I wasn't getting hair gel and putting it in every day like I would when I would go to work. That's just something that wasn't happening. So you're seeing that shift, and that's what's driving these inflation prices. But really just moving on from this, just to set the stage, going into the rest of the presentation, this graph is going to show you a timeline of inflation from 1940. That's going to be pictured on the top. And then right beneath that, you're going to see really how the CPI basket is broken down, how it's weighted. And then directly to the right of that, it's going to be how those price levels have changed really over the course of 2021. But what we can do is really take a quick walk through this timeline on the top. Starting all the way to the left, you have the 40s and 50s. You see some elevated price levels. That's going to have to do with World War II. You had a large amount of money getting injected into the economy, and some elevated inflation levels there. And that'll bring you through the 60s into the 70s and 80s. Now, this is going to be an important one. You have the 70s and 80s. It's going to be a time period where I would say it's elevated and prolonged inflation. A lot of, I would say, investors and media outlets, they're trying to make a direct comparison to those levels. Although we have some, I would say, structural data that we've looked at and researched that kind of proves that may not be the case. I mean, just during this time, you have several supporting variables that set the stage for, I would call it runaway inflation. You're looking at just elevated inflation over a long period of time. You had expanding international trade, economies in general were just growing. You had soaring wage growth. You had energy prices that were substantial. And then you couple that with money being injected into the economy, as well as a very hands-off Fed. That just led inflation to get to out of control, I would say, levels. I mean, eventually it does subside towards the end of the 70s. You had a regime that came into the Fed that put more restrictive monetary policies in place, and that helped subside these prices. And that brings you right into the 90s and 2000s, where you still have that more hands-on Fed and that more hands-on approach, but you have stronger world economies. And then you also have very, I would say, advanced movements in technology. All of that helped keep prices in check over that time. Over the 90s and 2000s, you see inflation pretty much stay in check. Now, the one change here is coming all the way at the end of the graph. you're going to come into 2021 and you're going to see a price level that jumps up similar to what was seen in the 70s and 80s. And so, I mean, there's those comparisons that are trying to be made there, which is, I mean, it's understandable. You're seeing a level that's very similar to what was occurred in the 70s and 80s. But these price levels are pretty uncomfortable and they are sharp. Everybody is feeling it, but we don't feel like they're going to be persistent. As mentioned earlier, you have fundamentals today, which are much different than we saw in the 70s and 80s. The US and world economies are in totally different places, and runaway inflation really isn't likely at this point. And that's going to have to do with, I would say, several structural reasons. I'll kind of run through these reasons. We do have a blog that was recently released by our internal strategists, which goes into these a little more detail. I'm happy to share that with the team after this call. It is long, but it's got super helpful information. I urge you to take a look at it. But for one, you have increases in global trade since the 70s. Global supply chains, they increased substantially. Again, you have the advances in technology. They kept prices in check. Massive shifts in demographics. Population growth virtually halved since the 70s. We've also seen lower immigration across borders globally that kept prices in check. And then you also have wages. They really weren't, they're not growing like they used to, especially pre-COVID. Partially that could be due to the union formation that reduced pretty substantially, especially in the US, and you just have less upward forces on wages. Now we are seeing some pressures right now, although we don't feel that's going to be long-term or structural or even consistent. But that's kind of where we stand and our stance on inflation relative to the 70s and 80s. But again, I'll get that blog post over to the team, and it should be a pretty nice read with a little more detail. But moving here to the next slide, it's really just a different way to look at inflation, where you can categorize it into two buckets, where you're going to have sticky inflation, you're going to have flexible inflation. Your sticky inflation, that's going to be that line in orange. It's going to stay pretty consistent over time. It's going to be your rents, your bills, public transit costs, and these stay stable, and they've stayed stable since 2000. Now, if you shift your attention to the blue line, that's going to be your flexible price items. These items, they tend to fluctuate over time. It's going to be your cars, your truck rentals, used cars and trucks, groceries and fuel. They're going to be the items that experience, I would say, the largest fluctuations. And this recent large spike that you're seeing all the way to the right, that's going to be due to the rising input costs and supply chain bottlenecks that we've been seeing because of this demand shift. Now, I would say in general, while these price levels are elevated, they've stuck around longer than we would really thought or liked. The resilience that you're seeing in the sticky price items, which is here in orange, that helps confirm what not only us, but most economists and strategists are thinking and believing, and is that inflation is going to really eventually subside. So this is a great view into kind of the two buckets of inflationary items and goods. There is one more view that we have, and it's going to be very similar. It's just going to separate it into two additional buckets. These buckets are going to be COVID sensitive and COVID insensitive items. If you look at these orange bars that are going across the bottom, that's going to be your insensitive items. They're going to be your utilities, tools, hardware, and you'll see that currently they're going to be slightly higher than what we saw through 2020, not quite as low as what we saw pre-COVID. And then you're also going to have your orange lines, which are going to be your COVID sensitive items. They're going to be your vehicles, airlines, tickets to the gym, and any type of goods like that. They're not going to be your durable goods. So you see some pretty large and significant increases here, all the way to the right-hand side of the graph. Now, similar to the previous slide, you have sticky more consumer staple-ish type areas of inflation, they've seen that slight uptick all the way to the right, but not to alarming levels. We do feel they're going to eventually, I would say, ease over time. And that's going to occur as we fix supply chain issues. Companies catch up to the purchasing powers of certain consumers. And we start really to, I would say, shift away from those do-it-yourself home projects that would entail kind of building out your home office. As you can see here, I'm sitting in my home office that we built out just because we're working from home. So that's kind of what you're seeing is people doing that and directing their demand towards those areas. But over time, we feel that's going to start to shift towards more going to restaurants and kind of getting back into the office and the swing of things. So that's kind of where we see, I would say, inflation currently, how we've seen inflation affect spending patterns and demand. But I think at this point, what we could do is kind of shift up and shift gears. I could hand it over to Ryan, where he can give you a quick breakdown of any type of like geopolitical concerns that are going on.
Yeah, thanks, Mike, and thanks everybody for the time today. Appreciate it. I think up to this point, Mike has obviously been focused very much on kind of spelling out what we've been all very well aware of, what we've been living through over the past couple of years, in particular, what impact COVID has had on price pressures kind of over the more recent time frame. But obviously there's a new crisis that has certainly caught everyone's attention over the past month or so, and that is the situation going on in Eastern Europe between Russia and Ukraine. And kind of before I get into a quick kind of discussion on what that means potentially for inflation and portfolios going forward, obviously I just would like to say that our thoughts are with those that are obviously negatively impacted by what is going on. Unfortunate part of Mike and I's roles is to talk through potential implications of major market events, and sometimes that includes things like war and humanitarian crises. So with that said, I did have a couple thoughts and comments related to what this means or what this could mean kind of going forward. And so, kind of starting with thinking about Russia and Ukraine is their impact on kind of global economic output. So Russia and Ukraine, as of last year, accounted for about 2% of global GDP. If you actually look at their, kind of stock market valuation, like how much does their stock market represent the global kind of investable universe of stocks, it was even less than that. It was around 0.3, 0.4% prior to obviously Russia's, stocks being essentially valued at zero here as of more recently, but still very small numbers. But so you might be asking yourself, so that doesn't seem like, a very large amount. So why should I be concerned? Why are the markets kind of going up and down crazy amounts every day? And the reason is really around the role that Russia and Ukraine play in key commodities that end up making their way into the goods and services that we provide. In particular, Russia is heavily involved in the global production across really a multitude of minerals and energy items that and metals that make it into our daily lives. For example, Russia accounts for about 12% of global oil production as of last year. They also account for about 50% of palladium production, which is a key metal used in the production of catalytic converters that obviously find their way into our automobiles. Ukraine accounts for about 50% of some of the key gases that are used in the production of semiconductors, which are obviously a huge part of our daily lives, from our mobile phones to our laptops to, again, our automobiles, given all the technology embedded in our autos these days. Obviously, semiconductors are a big part of the production process there as well. And even on the materials side of things, if you look at actually wheat and corn production, Russia and Ukraine account for about 14% of wheat and corn production. Now, thankfully, the U.S. is really isolated from a lot of these kind of individual nuanced components compared to, some of our friends overseas, and in particular in Europe, has a lot of exposure, especially on the energy side, to some of these things. So let's kind of talk about what this means in terms of potential impact to things like GDP and prices going forward, at least as it stands today. So right now we see oil trading. I haven't checked today, but yesterday we were right around $100 a barrel. If you were paying attention over the past couple of weeks, we actually got all the way up to about $130 a barrel. So it's come down quite a bit from where we were even a couple of weeks ago, thankfully. But still, it's a little bit elevated from where we were to start the year. So right now we're sitting at about a $10 or so per barrel increase in the price of oil. So we've kind of industry consensus on what that means in terms of its impact. About a $10 per barrel increase of oil would shave off about 0.1% of GDP in the US. A little bit more overseas, given the exposure of our friends in the Eurozone, that would account for about 0.4% in terms of a reduction in GDP output for the rest of the year. But then if you look at prices in terms of CPI, which are the numbers that we've been kind of talking through today, for the US, that would cause about a 0.2% increase in prices, and overseas in Europe, about 0.4% in CPI. So in the grand scheme of things, those numbers aren't alarming, right? And so that's ultimately probably the question you're asking yourselves is, what does this, potentially mean? Well, heading into the year, we were actually forecasting, along with most of our peers in the industry, a fairly robust economic growth again into 2022. Last year was a record year, probably unlikely to match that. But we were expecting somewhere around about 3.5% GDP growth here within the US, a little bit more in some other places overseas, but obviously we're focused on home here. So let's talk about 3.5%. 0.1% reduction means 3.4. If you compare that to what we were seeing kind of over the past 10 to 15 years, we're seeing only about 2%. So that's still a really strong number. So we might see some increases here in prices over the next 6 months. But they should be contained, and hopefully this some of the news that has come out over the past 24 48 hours is relatively positive. I emphasize relative, right, because there hasn't been a lot of good news on this front lately. But if this is eventually de-escalates over the next couple months, we would expect a recovery in the back half of the year that would ultimately prove to be positive for portfolios. So I know in times like this, it feels like you need to do something, but usually sometimes the best thing is to do nothing. Markets are down about 10% since the beginning of the year. Depending on your mix between stocks and bonds, are somewhere between down 5 to 10%. That is normal on an annual basis. 2021 is not the best comparison year because it was a rare year. Most years we see reductions in values like this, about 5 to 10%. So if these are levels that are concerning to you, now would probably be a great time to revisit how you're positioned with your advisor and have a conversation if these type of volatility levels are uncomfortable. So Mike, I'm happy to pass it back to you.
Sounds good. Thanks, Ryan. And I think wrapping things up, getting into the home stretch here, we can take a look at how inflation really has affected asset classes in general and portfolios. So taking a look at this slide, what it's going to do is it's going to break down inflation into 4 categories since 1980. So what you're going to have is, starting on the left, you have high inflation going all the way from above average, below average, and low inflation. And one thing I do want to add here is each of these, I would say, categorizations, they're going to include different times of geopolitical crisis and just crisis that could affect the markets. So you're going to see these, I would say, the performance of these asset classes. There's going to be those effects that lie in each of these categories. One consistent trend that we are seeing is really equities. They're going to be performing strong in every category that's illustrated here. In most situations, like Ryan mentioned, and depending on your risk tolerance, you're going to have equities. They're going to be one of the biggest allocations in your portfolio, and they're really going to act as a very strong and solid inflationary hedge over the long term. It's also worth mentioning that you also have different asset classes that perform very well when you have high inflation. For instance, you have commodities. They're marketed to really be a very good inflationary hedge. And I mean, it's true, it is true. However, when you kind of venture away from time periods that aren't high inflation, commodities start to perform, say, towards the middle of the pack. And then when you get into times of low inflation, that would act as a meaningful drag to your portfolio. Looking all the way at the bottom right, you see commodities down over 11%. Another asset class that performs really well within inflationary environments, specifically above average and below average, is going to be real estate. They have pretty strong inflation that ranges anywhere from the mid to upper single digits, and then even top of the pack in those above and below average inflationary environments. But one thing that I kind of want to direct your attention to is going to be these green boxes. That's going to be your balance allocation. And the main point here is diversification works over each of these environments. Over the short term, it may hurt because you're going to see different asset classes perform better than others. You're going to wonder why you didn't have more of that asset class. But what it is over the long term, what you're seeing strong and consistent returns really across the board. And that's, I mean, ultimately going to help you stay on track and achieve the goals that you're trying to achieve, rather than trying to chase performance in certain asset classes. Sure, it makes sense to kind of lean into asset classes if necessary and your risk tolerance asks for it. But overall, and the overarching theme is kind of staying to the course. But I would say just kind of wrapping this slide up. And one thing I didn't mention and didn't bring up throughout the conversation is inflation is a backward-looking number. While we do have the crisis in Ukraine, it may prolong it a little bit. It really doesn't tell you anything about what's going to happen over the next 12 months. And I mean, trying to set your portfolio up based off of what already occurred could be a mistake, especially coming into a rising interest rate environment. We had the Fed go on and speak today saying rates were going to increase, and there were going to be about 7 increases over the next year. So it would make sense not to rely too heavily on historical inflation data to make any, I would say, unruly changes within your portfolio. But just kind of taking a step back here and wrapping up the presentation. If there were, I would say, 2 main things that I'd like you to take away from this, it's inflation is high, everybody's feeling it. It's going to be important to remember that the levels of inflation, while they do look very similar to the 70s on a graph, you have structural shifts that support lower inflation. Inflation's a backward-looking measure. While some asset classes perform better than others during high inflation, a balanced portfolio or a more diversified portfolio, it's shown to deliver a strong return stream, consistent return stream, and it helps keep you on track regardless of the inflationary environment or geopolitical environment.
That's awesome. Thank you so much, Michael and
Of
Brian.
course.
Appreciate it. I think so. Katie Toth, our associate wealth advisor, was kind enough to organize us today. And Katie, don't we have some questions that got submitted that we could present or ask our presenters?
Yeah, I have 2 questions from our participants today. The first one is, one of the major contributors to inflation is oil. How does the US government control the price and thus reduce inflation? Any thoughts on that?
No, sure. So, I mean, it's a fair question, good question. I mean, overall, the US doesn't, I would say, put limits on gas. That's something that did occur in the 70s. And that was one of the overarching themes that did lead to the inflation and prolonged inflation. Although really, as we discussed kind of earlier, it's the certain measures that can be taken when it comes to increasing oil supply and take some of those pressures off prices. And that's going to be your deals with other countries, OPEC production increases. You're going to have the release of strategic reserves by the US and Europe. So those are all measures that can help alleviate some of the supply issues and constraints, which would then flow into the pricing. as well. So.
And our second question, you touched on this a bit, but do people need to dust off their gas cans from 1973? How is this different?
Right, and that's a question that comes up often. I mean, I've heard it a few times, and I guess what it comes down to is oil and energy production. It's changed over time. Since the 70s, since 1973, we've become more self-sufficient when it comes to energy. I know there's a lot of concerns going on with Russia, where we source our oil. And I mean, in reality, and I think Ryan may have mentioned this, is, I mean, we're sourcing about 8% of our oil from Russia. So in the grand scheme of things, it's very well insulated, and we're very, very well insulated. I mean, we have our trading partners, they could potentially help reduce that. And then another point to make, Ryan and I were having a conversation about this yesterday, is since 1973, cars are 93% more efficient in terms of miles per gallon. So we have very, I would say, attractive improvements in the efficiency that we had with our cars relative to what we saw back in 1973. People in general aren't driving as much. Infrastructure has improved. So while gas prices are high now, there's additional uncertainty. We are diversified when it comes to where we source our oil, and we have seen some pretty significant improvements in the efficiency. So that should help paint a different picture than what was seen back in 1973.
Well, thank you so much. That wraps up our Q&A section. I'm going to have our founder, Sarah Carlson, conclude this meeting.
Yeah, so thank you, Michael and Ryan, for a great presentation. And thank you for all the participants. Thank you for taking time to share this learning hour with us. We realize this is such an uncertain time in this geopolitical challenge that we're in. And I agree with Michael and Ryan that so much of what's happening, the fundamentals are still solid, and we're here to help navigate and help you with your personal planning along the way. So in addition to myself, Katie Toth, Wealth Advisor, and Travis Messenger, part of Fulcrum Financial Group, we're here and on your side. So thank you so much for presenting, and thank you, Michael and Ryan. Appreciate your help.